nuts and bolts of what we're all about. We're also a price leader for high balance and FHA jumbo. So that's it in a nutshell about Quicken. If we want to jump into the QM piece, I have a PDF. If we can kind of jump through that page by page, what we did was we put together a we actually put together a document that what we call explaining QM in 5 minutes or less, which is kind of what you guys wanted us to do today. And we had already been working on this, so this is still a rough draft, so I apologize. If you see any typing or spelling errors, I apologize for that. But basically, if you look at the first page, it just talks about QM and what our requirements are going to be and how we're looking at it. So at present, we are only going to do safe harbor loans. So if you go to page 2, all loans, we're requiring early till on all loans that were received after January 10th. So we're going to run a points and fees test, a safe harbor test, and an HPML test on every loan. And ultimately, all loans will have to pass safe harbor. You want to hop to page 3. On page 3, it's telling you what our breakdown is for HTML versus safe harbor. So on conventional and VA, they're the same. But if you look at FHA, our safe harbor test is a little different because of the FHA requirement with the annual MI and the monthly MI being calculated into the APR over the life of the loan. So for FHA loans, they will most likely fail your HPML test, or several of them that will. In that case, we'll then do the safe harbor test, which is going to be the APR, or the APOR, which is the annual prime offer rate that comes out every Friday, plus 1.5 plus 1.15 plus the annual MI. So that way we feel like we have some more flexibility to still pass, we can still pass the safe harbor test and feel comfortable doing those FHA loans. On any other loans, so they will have to pass the HPML test for us to move forward with them. In the past, we were doing HPML in general, and that will no longer be the case unless it's an FHA loan. And then at that point, it'll have to pass safe harbor. Okay? You pop to the next page. It just talks about when we're going to run our test. So we're going to run that HPML test as soon as you register your loan with us. So you'll know when you register it based on the rate that you've chosen at registration if it's going to pass the HPML test or not. We're not going to stop the loan at that point, but we're going to let you know that it failed. And then I'm assuming that we can make sure that everybody gets this document, but if you look at it, just walks you through exactly what we're going to do. So we would require that you would do change of circumstance at that point. We're going to give you a worksheet. Somebody's going to contact you. We're going to give you a worksheet and give you ideas how we could fix that. And then you could do a change of circumstance to make that change at that point, or we'll let you move forward if it's failing, and then we can fix it at a later time as long as it's still floating. And at present, we don't have that visibility on our portal, so it would be us contacting you to let you know. And then the same thing with the safe harbor test. We're going to do that one also at registration. If you fail safe harbor, though, we aren't going to let you move forward because that's dead in the water. I can't do anything with that. I have to make sure that we can fix that. I don't have any loans that I can do that aren't safe harbor. Okay? Same thing you would do. You'd have somebody contact you. You would do a change of circumstance in that respect as well. So you go to the next page. On the next page, you'll see that what we'll do if it's failing safe harbor after the loan, if the loan's not locked and it's in-house and it still fails safe harbor, it'll trigger a condition on our portal for you, and then we'll be contacting you at that point to remedy that, so you won't be able to lock the loan until we can get it to pass safe harbor. And so then if it goes into a safe harbor failure, then we're going to stop at that point and work with you to fix it. So if you scroll down a little bit under there, it tells you what our limits are going to be. So 3% for $100,000 and up. And I think this is basically the law limits. I don't believe we're varying from that. So from 60 to 100, we're going to let you make $3,000. 20 to 60, then you're at 5%. And I don't really think we're going to be seeing loans below 20,000. So that's just a breakdown of how we're doing it, and that's specific to us. And if you go to the next page, it'll show you that we're going to actually not run the points and fees test until we actually initially underwrite the file. And at that point, then we'll work with you if we need to lower fees or what have you, and do the same. It's always going to be the same process. Somebody's going to contact you, request that you submit a change in circumstance to us to remedy it, and then move on from there. And then it's also, you'll see also a trigger on our portal, like a condition for that as well. And then if you go to page 7, page 7 is just a breakdown of the fees that we're including in our calculation. Some of these could change, and we're already in the works of possibly removing some of these fees. So what we've noticed is that we have some lenders that are, hello? Am I still on?
No, you're still there.
Oh, that was weird. For some reason, I thought I got kicked off. So some lenders are allowing a buyout of the underwriting fee. As of right now, our underwriting fee is still being included. February 1st, I think that we may consider an offering where you could have a rate sheet with the fee in it or a rate sheet without the fee. That's still up in the air. So I just want you to know that at this point, things can still change. Also, one of the fees that we're including that I think we're going to remove is the settlement and closing fee. Right now, we are counting it on every loan, and we believe as of February 1st, we're going to be removing that. So if you scroll down a little bit, it tells you what fees we have excluded. And the only time we're going to include those fees is if they are an actual affiliate. And then if you go to the last page, this is frequently asked questions. So this document is super quick and easy to understand. I think we've kind of simplified it just in that it is solely how Quicken is looking at QM at present. One of the things that you guys had asked, you had sent us the email to participate in this, was about the 43 DTI. We are allowing that as long as they are an approved eligible, will accept above a 43 DTI. So what happens is they have to be an approved eligible loan to be above the 43 DTI, and then they'll also have to pass the HPML test unless it's FHA. At that point, they would have to pass the safe harbor test. And then, of course, they're always going to have to meet QM points and fees test. That's it.
All right. Well, fantastic. Marcia, thank you so much for sharing that. And you were absolutely right. That was QM in 5 minutes.
I tried to keep it to 5 minutes.
All right. Excellent. Well, great. And what we're going to do, just to remind everyone, is that we'll take questions at the end. Now, is there anything in particular that you would like our membership to know specifically about QM from a Quicken perspective?
Something that we did discover is that anyone who is using Calyx is not calculating the QM points and fees correctly. So we are in touch with their management to try to work with them so that it is more closely assimilated to what everyone is doing in the marketplace. Another thing, any of the yield spread premium that is going to cover third-party costs, whether you're doing a borrower-paid loan or a lender-paid loan, those fees will not be included in the points and fees test for Quicken. However, we have discovered that not everybody is doing it that way, and also in Calyx, it doesn't look like they're doing it that way. So it could be that somebody thinks they're failing and they're really not.
Okay. Well, excellent. Thank you so much for sharing that information. And then, as I said, we'll take questions at the end, and we'll kind of just move on now to the next one. We've got Kelly Allred. Kelly is the account executive for Franklin American. So, Kelly, take it away.
Great. Thanks, Andy. So I'm going to try and sum up Franklin American in about 30 seconds here. So Founded in 1993, Franklin American is a well-positioned, privately held mortgage banker headquartered in Franklin, Tennessee. As NAMB's 2013 Affiliate of the Year, we pride ourselves on our commitment to value each customer we work with while maintaining the responsiveness of a smaller organization. To scratch the surface of some of our wholesale division's highlights, we offer our mini correspondent program called Emerging Mortgage Bankers, our Q-Docs where we deliver docs within 5 hours, TBD underwrites, our superior technology, and of course a dedicated account executive who's been with Franklin American going on 7 years. I think I made that in 30 seconds. Obviously, for those of you on the call and not currently with one of our partners who would like to know more about Franklin American and myself, please feel free to contact me so we can schedule a time to meet and discuss a possible partnership. I'll go ahead and give you my cell phone number at the end of the QM portion here. Now for the fun part, the reason you all joined the call today. Let's talk about Franklin American's hot topics regarding QM. So to get started, let's talk about comp. We do allow you to choose your lender-paid compensation range. So for Missouri, our brokers, not bankers, can pick their lender-paid comp ranging from 1 1/4 to 2 3/4. We do allow you to set a ceiling dollar amount, but currently we do not offer a floor option. As far as how often we will allow you to change your lender-paid comp, we are allowing once a month, but if needed more often, we're reviewing these on a case-by-case basis, and we ask that you allow 24 hours for the change to take effect. We are still offering borrower-paid compensation and allow you to go down a full point from your set lender-paid comp. So for example, say you set your lender-paid comp at 2%. You can go down to 1% on borrower-paid. We also allow you to choose on a loan-by-loan basis whether you want borrower-paid or lender-paid. If mid-process you must switch compensation methods, we're currently allowing you to switch from lender-paid to borrower-paid on a case-by-case basis. In regards to waiving our admin or underwriting fee, we are allowing this for lender-paid comp only. We call it our lender admin fee buyout. We do allow you to either waive or include our fee on a loan-by-loan basis, which you must select at registration whether you are waiving the fee or not. Once this adjustment is selected during locker registration, whichever comes first or occurs first, it cannot be changed. You also will not be allowed to switch from lender-paid comp to borrower-paid comp once the adjustment is selected. If you do choose the option to waive our fee, you'll be subject to a loan-level pricing adjustment. We have the adjustments broken down by loan amount tiers that range from 1/4 to 1 3/4. The larger the loan amount, the smaller the adjustment. Also, Franklin American doesn't charge anything above and beyond our admin fee, so there's no tax service, no flood, etc., just the admin fee. Some of you have asked if we will allow excess premium to cover our admin fee if you choose to not waive our fee. For right now, I would say no, but it sounds like we may have something in the works to possibly allow excess premium to cover our fee, so stay tuned. In regards to loans with DTI ratios above 43%, Franklin American will consider for purchase as long as they are underwritten to agency guidelines and follow program DTI requirements. In regards to discount points that are bona fide, we are allowing them to be excluded from the points and fees test as long as they don't exceed 2%. Any discount points in excess of 2% will be included. So say you have 2 1/4 in discount. The quarter would be included, not the full 2 1/4. So in regards to the QM test, we're going to be running the points and fees test throughout the process of the loan, not just at the beginning and the end. So if there is a loan amount or rate change in underwriting, we will be running a test to make sure your loan is still within tolerance. Now, having said that, these tests are run based off of the fees our customers are including in their fees worksheet. So if a customer misses an APR fee, this could affect whether you are in tolerance or not. Loans failing the points and fees test can potentially be cured prior to funding, provided other regulations are not violated. One of the value-added services I am offering my customers is I will personally go over your loan fee worksheets with you and help you calculate both calculations required. We'll calculate the total loan amount, which is basically your loan amount minus any APR and affiliate fees, and then the other calculation, which is the QM total points and fees, to make sure your loans are within tolerance upon submission. Franklin American does have an APR matrix, and when we meet, I'll go over with you your typical charges to determine what is and isn't an APR fee. This is key right now because I know some of my customers are basing their QM points and fees based off the loan amount times their comp and not the total loan amount, which again is the loan amount minus any APR and affiliate fees. We're finding how important these calculations are, so make sure, if you are my customer, to reach out to me on every single loan you submit until you get this down. My goal is for my customers to not have any QM calculation issues. Also, we do encourage our customers to please ask lots of questions. You can, of course, contact me on my cell, and it's 636-484-2676, or you can use our QM dedicated email address, and that's qmquestions@franklinamerican.com. So that's all I have. I just want to thank everyone who joined the call and the MAMP for having this call.
All right, great. Thank you, Kelly. I really appreciate you taking the time and doing that. All right, next up is Flagstar, and we have Holly Durzo and Chad Brown. I know Holly had sent a message to me that she may have to have jumped off earlier, but Chad is still going to be here. So
I'm still on too. It's Holly.
Oh, hey, Holly. All right, well, good. You're still here. Take it away.
Okay, so I will go over kind of the 30 seconds about Flagstar, and Chad is going to take it away with QM. Flagstar is a bank. We've been in business for about 26 years. We're based out of Troy, Michigan. We do conventional, Fannie and Freddie, FHA, VA, USDA, jumbo. We do have warehouse lines. We also do underwrite to be determined, and we go down to $75,000 on the warehouse lines. We work with brokers, correspondents, and delegated customers. So that is my 30-second spiel about Flagstar, and I'm going to let Chad take it away with QM. Chad, you on? So anyway, for those of you who don't know us, Chad and I do both service St. Louis. So if you guys do not have a Flagstar account executive, we would be happy to help you.
All right. Maybe having some technical issues with Chad.
I'm right back on. Sorry, I went to unmute myself, and no, I'm good. Sorry.
All right, Chad, go for it.
Where were we at? I'm sorry. Should we just go into discuss June because I missed Holly's opening?
Yeah, well, Holly kind of just introduced Flagstar, and she basically said, anything that we need to know, you're the man to talk about.
Absolutely. Just a couple of points that we'll take. We'll start from the email that we kind of want to discuss. In regards to our compensation range, we have a minimum of $1,000 per loan and a max of 2.75 that our brokers are allowed to set up to. We are allowing admin fees to be waived and built into our price. Giving you a customer of us, contact Holly or myself to adjust that for you. At this time, we're not changing fees by loan. This is something we're working on. It will be integrated and should have, hopefully, for the next month or so, completed. I know there are some investors out there at this time, some of our competitors, that will allow borrower paid compensation to be lower, if you will, than the lender paid compensation. We have researched this in its entirety, and we are not allowing that actually at this time. We feel from the legal departments and places that we have contacted, it's best that we do not do that. We are going to continue to research that, but at this time, Flagstar will not allow the borrower paid compensation to be lower than the lender paid. At this time, the lender paid compensation can't be adjusted per loan each time. However, that may as well be changed in the future. We are, as Kelly had mentioned previously, going to allow, I believe in February, given you set up a new compensation at the time at 2.75, we're going to allow our customers to take about a month to try to figure out the whole QM, to run several tests, to get things to kind of work out, to fill it out the first 30 days. And we're actually starting in February, will allow you to change your lender paid compensation, giving you one to increase or decrease as far as that goes. And that's pretty much as far as that email bit goes. Do we have our memo up? Yes, we do. Can you scroll down to page 2, if you would, please? A couple misconceptions, too. Just being out in the field, discussing with different customers, and I'm sure by now we're a couple weeks into the QM. things that people are starting to figure out. The first one actually that I had found a lot, and maybe I might reach out to 1 out of 100 people here today, is it's the amount of finance, obviously, if you don't know by now. And, you know, when this first rolled out, everyone was taking that 3% times total loan amount, and a few were passing. However, you know, we started running tests, you know, 3 months ago on several deals and just trying to figure out where we were at. And, you know, we were cutting people back to that 3%, but as we figured it out, it was failing 100% of the time. And that's where we're getting our 2.75 from. And it's best to be conservative regarding that. That's one thing. And number two, you know, correspondence. You know, I also thought, you know, a lot of people were filling the correspondence, even though you are an investor, you're lending your own money, that you get to get away from the 3% rule, and that obviously is not the case. Now, given you don't have, you know, any credit box 2 GSE that you have to count into this or anything of that nature, yes, you get around it. However, just keep a note, if you are a correspondent member, you are still subject to the QM as far as the 3% cap goes too. What I wanted to show regarding this page 2 is, as I mentioned before, the points and fees not exceed following caps, 3% for the loan amount, the loan greater than or equal to 100%. Now, obviously, as your loan amount decrease, your ranges will actually increase in percentages. And again, that's something that I'm not sure if everyone's doing. That's how we're following. Holly, is there anything you'd like to add?
No, I think you're doing a great job.
And that pretty much is it for me at touching the points as far as the questions given to us, you know, via email to touch base. And if you have any questions, you can contact me. My contact information is 636-795-4339. And if Holly, which I'm sure she probably did mention it, we have been lending to warehouse lines for over 25 years. We have an amazing platform for it. We've converted several brokers to correspondents, and it's obviously one of the things that we've become extremely successful with. So given that's a route that you would like to take, please contact one of the two of us. Holly, if you'd like to get your information, please feel free.
Sure. My cell phone number is 618-530-0863. And thank you guys for letting us be on this call.
Hey, no problem. I'm ready.
Well, thank you very much for both of you jumping in. And I think we're going to round up our panelists with Corey Moore, and Corey is with Stearns. And I'm not sure if Jim made it on or not. But Corey,
Andy,
please feel free to kind of tell us a little bit about Stearns.
Andy, can you hear me?
I can hear you fine.
It's Jim Sertle. How are you?
Oh, Jim, fantastic. I'm glad you made it on.
No problem. Had a little technical difficulty in the beginning, but glad I'm on. So appreciate, thank you for having us. A little bit about Stearns. We're a privately held independent lender. We basically about $10 billion in servicing. We were the #2 wholesale lender in fourth quarter of last year. We're a direct to Fannie, Freddie, Ginnie, and servicing about $30 billion right now. Soon to roll out a mini-core program, probably as early as March 1st. Basically headquartered in Orange County. About 1,600 employees. We have several branch locations throughout the United States. Mine is in Chicago, Illinois, is where most of my customers are taken care of in service. So again, consistent pricing, very qualified and competitive service. And again, you have conforming FHA, VA, USDA, and jumbo products available to you. So we are extremely committed to the broker channel and are there to help you through this QM challenges that we're having. So a little bit about where we are with QM. Our current compensation range is anywhere from 0.5 point up to 3%. We are reviewing that currently, and that could change in the future. Again, that is calibrated in 1/8 increments. Again, do we allow a waiver of admin fees? Yes, we allow that to be rolled into the rate. You have that option when you're looking at pricing your loan on our quick pricer on the website. So you have the option to either have that in or keep the fee as is. Can we change the fee by specific loan? No. That fee, again, you can, yes, you have the option to either roll it in or not, but that fee, that specific dollar amount fee would not change. I know a question I get a lot is, do we allow our borrower paid compensation to be lower than our lender paid compensation? Yes, it can either be lower or equal to, but cannot be any higher than your current lender paid compensation choice. Can you adjust your lender paid compensation by loan? No. Currently in this first quarter, we are allowing you to change that on a monthly basis, usually the last 10 days of every month. And then after the first quarter, you will then have that option to change every 60 days with your lender paid options. And again, that could be subject to change as we roll forward into this year. Do we allow excess premium to buy out lender fees? Again, you could use your excess fee, your excess premium to cover your fees on there. And do we allow a floor or ceiling? Yes, we have a minimum floor and a $15,000 ceiling currently. And then what we have on the webinar here, again, this is I'd really give kudos to my senior management team as well as our attorney group. We did, I think, a really tremendous job and continue to keep examining this situation. This PowerPoint that they put together is tremendous. Kind of covers the nuts and bolts from the definitions of QM to what's counted as far as points and fees, to again what our stance is on things, and then breaks things down even to a definitive aspect and what you're looking at. Discount points, we have everything in this PowerPoint. So again, feel free to reach out to me. Again, it's Jim Sertle with Stearns Lending. My cell phone is area code 314-220-2891, and I'd be more than happy to answer any of your questions.
Can you give me that number one more time, Jim?
Sure. It's area code 314-220-2891.
Great.
All right. Well, thank you, Jim. Is there anything that you feel that our members should know specifically about QM as it pertains to Stearns?
You know, I think it's one of those things we're looking to try and help you in any aspect we can. We do have, you know, throughout the process, obviously we're doing a check with a system called Mavent behind the scenes. So we do allow some flexibility to, if for some reason your loan came up with a QM violation, we look to try and fix that in certain aspects of that. So again, we're just here to try and help everyone through the process and you know, get back to originating loans.
All right. Well, fantastic. Well, you know, for all of our panelists, thank you so much for sharing. What I'd like to do now, since it looks like we've got about 15 to 20 minutes left, is to allow our members to ask some questions, if that's all right. Eric, what's the process now for this?
Well, the best approach that I've found is to go ahead and get people thinking about what's going on. There's a couple of questions that I know that I've had several of my clients express and concerns or interest about, some of which was covered, but maybe it's a good idea to just kind of go back and summarize a little bit here what we've uncovered, in the interest of just you know, trying to give somebody some visual reference for what we're doing. So basically, the majority of what I'm hearing on this call, and if you guys would all chime back in, okay, so lender admin fees. What is, you know, who's including them and who's allowing waivers based on the panelists that are here in the program today?
It's Chad Brown, and again, Flagstar Bank will offer either way. Given they want to be a part of the closing, then it will be. Given you want to waive that and build it into price, we allow that option, and customers need to just come to us so we can take care of that for you.
This is Jim Sortle with Stearns. We allow either option, and you have that option when you are pricing out your loan.
Okay.
This is Marsha with Quicken.
Okay.
So at present, we do not have the option to buy out our fee.
But that is under review. Watch for updates.
Right, yeah, we're anticipating that to change probably in February. So it's something we were discussing but hadn't built in yet.
Okay. And let's see. Franklin, Kelly, or Andy, you want to chime in?
Yeah, we are allowing our fee to be waived. Again, we call it our lender buyout, and it's a sliding tier. So basically the larger the loan amount, the smaller the adjustment, and it ranges from 1/4 to 1 3/4. And you must select it at either registration or lock.
Okay, and is that loan by loan, or is that, because some of the lenders...
Loan by loan basis.
Okay, all right. So this has been a fun, exciting thing. You know, trying to coordinate presentations from 9 different panelists is always a bit exciting. So I hope everybody appreciates me taking just the opportunity to throw this into a Word document, which I can forward out along with all the other presentations that you all have been seeing in the background. Guys, as you know, those of you listening or attending on the background, feel free to go ahead and drop in those questions into the Q&A sections on the webinar. You know, at this time, go ahead and dump in some of the other questions that you may have. I know that one of the reasons that this has become an issue or concern, and one of the bigger opportunities that I think that this creates is you know, just to look at and reevaluate our partnerships with the lenders that we work with. And I'm just going to, you know, on behalf of the association, I want to express an extreme amount of gratification and appreciation for the, you know, the panel of experts here who've jumped in and stepped up to support our professionalism. The Missouri Association of Mortgage Professionals is totally dedicated to helping create the best possible lending environment for the more, you know, I mean, who are we? What do we represent? MAMP is the organization that represents the frontline originator, the independent mortgage professional who's seeking to have the greatest variety of options available for their consumer to make the best choice of what's out there in the market instead of being handcuffed with one single channel. And so, you know, that's the reason that I applaud and highly thankful that we have great lending sponsors like panel of experts that have joined us here today, Flagstar, Stearns, Quicken, Franklin American, and a host of other sponsors that are loyal and long-term supporters of MAMP, NAMB, and what our association is seeking to accomplish. That's part of the reason that we launched this educational series this year, is to make sure that what you need as an originator to be able to handle the complexities and the information of the real nuts and bolts, you know, what's available to you in the market and how to make it work for your consumer is probably one of the most valuable things that we can provide to our members and our association, is the ability and opportunity to get just the nuts and bolts information that you need to be able to make quick decisions and continue to move forward with what you want to do about doing what's right for your consumer and empowering the American homeowner. So a big thank you to all of our panelists today for jumping in and joining us. I'm sure there's a million other questions, and just as fast as we were ripping through all this information, I'm sure that there are some others out there. If you would go ahead and post those into the Q&A section at this time, you know, please let us know what you want to hear about from these great panelists and these you know, knowledgeable professional individuals who have volunteered their time to participate with today's program. Let's see. Okay, so and Marsha, you just posted some things in the Q&A. why don't we go ahead, I'm going to go ahead and cut and paste that into populating that for everybody else. But Marcia, why don't you go ahead and elaborate on what you were kind of looking at with this information?
Oh, so basically, I just took those 7 factors and responded to them that you had, so that they know exactly what we're doing and have in writing. So you gave us 7 different key components to touch on.
Oh yeah.
And so basically, I just put compensation range up to 3. We're not currently waiving our admin fees. You can change your fee by loan as long as it's borrower paid, and the borrower paid compensation can be higher or lower than the lender paid compensation. And you cannot adjust your lender paid by loan. However, it used to be every 90 days. We are offering more flexibility on that due to QM. You just have to email me, and I would push it through to my approval department. And then we are using excess premium to buy out third-party fees, but not lender fees. So, and then those third-party fees will not be counted in the QM points and fees test. And I think that one is the one that may be is different from lender to lender. And then you can have a floor and ceiling. So basically, I just answered all of those in a nutshell. And then just our take on it is that we think that we're going to see a lot more LOs that are going to be doing borrower paid compensation, because if you do a borrower paid versus a lender paid with the exact same scenario where the yield spread premium is the exact same amount and they charge their fee up front with the same yield spread as a borrower paid transaction, it seems like they're passing because those fees are not now counting in the QM points and fees test, because you're using that money to pay all of their third-party costs versus using that money to pay just their comp. And so it tends to work out better as a borrower paid transaction, whereas before so many people were doing lender paid. But now your loan officers can get paid on borrower paid once they change that ruling. So we just feel like we're going to see a lot more of that taking place.
All right. All right. So other questions, Andy? I know you and I have circled this around behind the scenes in multiple conversations. Other things that you feel haven't been shared yet that need to be shared, and that maybe we can have our panelists chime in on.
I would tell you that I think I had shared this initially. Is one of the biggest challenges I'm running into as I work with brokers is just calculating the amount financed. And I know one of the biggest challenges has been in a brokered transaction. I believe that most brokers are sending in their fee sheets or completing them on the lender's websites, and then the lenders are sending out the TILs, which in turn, essentially the lenders are making a determination on which fees are included in the APR. What I've noticed as I'm speaking to many of our customers is that when they're entering their fees into Calyx or whatever software they're using, they seem to be checking certain fees as APR fees that they should check, and then they're not checking fees that they shouldn't be checking. So it's one of those situations where my recommendation to everybody is that you need to check the lender's APR matrices. Now, for all of the panelists, do you guys have some form of matrix available to the brokers so that they can see what fees they should and shouldn't be including into their calculation? Marcia, do you have something for Quicken?
Yeah, we do. I mean, it was on page 7 of the document that I included. We also have something that is called What's In, What's Out, and I can send that as well if you wanted to push that out to people. But
okay.
It's a little more detailed. That one is kind of just a quick snapshot of what we're including, which was on page 7 of that. I think it was 6 or 7 of that document that I went through.
Okay. And Jim, how about you for over at Stearns? Do you have a document that kind of breaks things down for the members? And
on the presentation that is up on, it's 53 pages, but we got several different areas that covers that. As far as points and fees, I think starting on page 24, we provide some examples, and then we also have a breakdown of what, let me find what page that is. On page 37, which talks about potential APR fees that they need to be aware of. And then we provide several examples, breakdowns of individual loan scenarios, which what would be eligible and what would not, and several different avenues on there.
Okay, perfect. And Eric is kind of sliding through your presentation on page 37.
It's long but thorough, and if anybody needs it, feel free to call me. And I think you guys are going to be getting these out to everybody, correct?
Yes, we are.
Great. Thank you, guys.
All right, excellent. I know Kelly has one for Franklin American.
It's Chad
Holly,
Brown Flagstar.
Chad, do you guys have one for Flagstar
Yes,
also?
we do. Yeah, I was going to mention that as well. In our memo there that you'll be sending out, bottom of page 2 is where point of fees test begins, and we break it down specifically as what's going to be counted, what won't be counted, et cetera. I believe it ranges through page 4, so there's a couple pages on it.
All right, excellent. I know that's been one of the biggest challenges. Somebody had mentioned, I think it was Marsha, you had mentioned that things weren't calculating properly in Calyx. Marsha, is there anything specifically when you say it's not calculating properly, what were you referring to?
Basically, we had it came up on our conference call with management because they had already reached out to Calyx, but they were noticing that the partners that were using Calyx, when they ran some test scenarios, the fees that Calyx was including, and it may be just a matter of them like checking the wrong boxes or what have you, like what you were saying, was not the fees that were being calculated in Calyx were not giving it an accurate pass or fail. So sometimes it was calculating too many fees, and sometimes it wasn't calculating enough fees. So sometimes they're passing when they shouldn't be, and sometimes they're failing when they shouldn't be. And so we were trying to get specifics with Calyx management to try to get everyone on the same page. And part of our big difference with us was the fact that we are taking that yield spread overage, and then those fees that are paid by the yield spread overage or paid by any yield spread if you're doing the borrower paid compensation, then those are not being calculated in the point fees test. However, Calyx is still counting them.
Okay, so what you're saying is Quicken is you're using any of the credit to pay for any of the closing costs, specific closing costs, and whatever they're utilizing to pay for closing costs, you are excluding those from the calculation.
Yep, exactly.
From the APR calculation, and that would be the calculation to come up with your amount financed. Am I hearing that correctly?
Mm-hmm. Yes.
So because you're utilizing those, that premium for that, you're excluding them, and Calyx is counting them in based on the information that you received.
Right.
Okay. All right. That's important to know for our members if that's happening.
Right, and I will request more details because I don't know where we're at on that. That was just from last week's call, so I don't know if we made any headway with them or not. I haven't had any updates this morning.
Okay, fantastic. There's probably one statement that I would make just for our members, and I would say that even on this panel, you're hearing that there are some things that some of the lenders are doing differently as it pertains to either calculating the amount financed or including certain fees. And what I would say to everybody is that over the course of the next 90 days, you're going to find that lenders are going to be fine-tuning all of their QM processes and procedures. Some of them are going to stay the same. Some of them may get tweaked. I think it's going to be up to all of the lenders to try and get some of the more specific answers from either the CFPB or from their respective compliance teams and law firms. And for everybody in the industry, I know that the QM was a major industry-changing event. And I would tell you that there probably isn't any way for any one particular lender to have all of the answers just yet. It's going to be a work in progress. And I would also say that if one particular lender is doing something one way and another lender is doing it a different way, it doesn't necessarily mean that one lender is right or another lender is wrong. What it might mean today is that there might be lenders that are doing it a certain way because of maybe a lack of technology and back-end systems to calculate certain things in certain ways, and they would rather be more conservative. Or in some cases, it could be risk, where some lenders may decide that they're just going to be a little more aggressive right now, and other lenders may decide that they're going to be a little more conservative. It doesn't mean that they're right or wrong. It just means that that some of it has to do with just their take on things and what they're willing to kind of stick their neck out for in the short term in the absence of specific response and answers from the CFPB. So kind of coming full circle to things are going to be changing a little bit over the next 90 days, and I know this is a little challenging. But I am very thankful for all of our panelists to take their time and jump on here and at least just share their approach to QM, so that each one of you individually has the opportunity to reach out to each one if you have concerns, and have each particular lender and account executive kind of help you through their process. Eric, have we gotten any more questions in?
Yeah, it's a little bit dry on the question and answer boards, but that's okay. I mean, I know it's a lot of information to absorb, and we did some quick fire response type stuff here to try and get this information in front of you guys. I guess the last thing I was going to share with everybody is we certainly have a host of great wholesale lenders and correspondent lenders in our industry in the state of Missouri that serve this area, and so all of the folks that are here today, I know, are very knowledgeable. They're very capable of answering your questions, and that's what they're really there to do, is to help you as a frontline originator or as a compliance officer with a Missouri mortgage company to get the information you need to be able to get a plan of action in place so that you can focus on production and increasing your purchase business. As we move through the next couple of months, we're going to be shifting back towards a little bit more of a focus on business development, but we're also going to be making sure that we're on top of governmental issues and changing landscape of the geopolitical environment and what that's going to have on impact on your ability to originate, in addition to the opportunity to come out and meet with the top AEs and the top mortgage companies in our area that are here to support you in growth of your production. Certainly the folks that are here on the panel today are some of the best in the industry and are certainly here to help. So I want to encourage you to reach out to them. For panelists, if you would, as I'm just doing some wrap-up comments, if you wouldn't mind, go ahead and post your best contact information, email, and phone number for folks that are attending or folks watching this on video. If you guys wouldn't mind going ahead and posting those in the Q&A at this time, and just go ahead and post them in. Actually, I take that. Put them in the chat section, but go ahead and post them for all entire audience to see. We will also we'll take a log of that, and all of the panelists on the program today will make sure we send out their contact information to all of you listening on these materials. We'll also make sure we get out the recording of today's program along with the supplemental materials provided by the lenders who volunteered to participate in today's program at the end of the program today. It will take us a couple of hours to get that done. The last thing I wanted to share with you is we are going to be doing a convention this year in April 8th, which I believe is a Tuesday. We are going to be getting together at the new River City Casino, kind of in the south part of St. Louis, just right along the Mississippi River. It's a great new facility. Our new contract executive, and in conjunction with Agility Resource Group, is coordinating with bringing in a more of a regional type conference, similar to what they've done in Utah and the Northwest with the Great Northwest Conference. And anyway, so I wanted to make sure that you all are aware we are going to be holding a convention this year. It will be April 8th. We're going to have a great group of programs from a wide variety of panelists and speakers, including some of the folks you've heard from today. In addition, there'll be definitely a sales training and business development track to that programming. I want to give you tools and resources you need to compete in a purchase-based market like we're going to find ourselves in throughout the majority of 2014. Otherwise, my last comment is sort of official role here with Missouri Association of Mortgage Professionals is we encourage you to join to support the organization that supports you. A past president from a couple of years ago, Dennis Tate was famous for saying, if you're not part of the solution, you're part of the problem. So if you get involved and you lend your voice, we love to hear comments and feedback from active members. Whether you like what we're doing, whether you hate what we're doing, let us hear you, because you can't fix what we don't know about, okay? So the other thing we're going to be doing is the leadership team and I are going to be getting together next week to do sort of a brainstorming and strategic planning roundtable next week, Monday, in Columbia. We're going to be getting together for that purpose. We're also looking for volunteers. If you're interested in creating a better future for the mortgage lending environment, for the independent mortgage professional here in the state of Missouri, we're interested in, and we're looking for people who are serious about making a difference in the community. So if you're interested in participating as a board member or on any of our committees, please let me know, and we will make sure we get you plugged in somewhere. Otherwise, a huge thank you to those folks that have joined us for today's program, our panelists. Andy, thank you for helping pull this together. And if there's any final comments from any of our panelists, I'll let you guys kind of close it out here and share with us any final thoughts for the folks that are listening in today. Andy, anything else you'd like to mention just before we close out?
Yeah, again, I want to thank each one of you for joining in on the call, giving us an opportunity to share some information with you. And if there's anything else in the future that you are looking for or you'd like to know more about, please don't hesitate to reach out to us. And you can respond to me directly also at acprasad, A as in Sam, E-E, P as in Peter, E-R, S as in Sam, A-D, at franklinamerican.com. And I'm also looking for some members for the GA committee as well. A lot of great things going on, and need as much support as I can get. So with that, thank you very much, and appreciate everyone jumping on the call today.
Thanks, Andy.
Appreciate your time. Thank you.
Thank you, guys.
Awesome. Well, like I said, folks, we have a great panel of experts. We've got a great new board for 2014 who are excited and committed and energized to help, help us make a difference in the mortgage community and for the consumer public in Missouri. So we look forward to a great year in 2014 and lots of new things to come. At this point, if there are any additional questions from panelists or guests or attendees of the program, feel free to go ahead and post those into the Q&A. Of course, you can always reach the association by going to our website at mamp.biz, www.mamp.biz, or reach the association or any of our board members through that website. Also email us at information@mamp.biz. Again, that website is information@mamp.biz. Otherwise, thanks everybody for joining us for today's panel. I'm going to leave the platform open for just a few more minutes for final questions to be posted in the website or in the GoToWebinar platform here, so we can get those addressed. If you have any specific questions for any of our panelists, you're welcome to go ahead and post those here in the Q&A. Otherwise, like I said, we'll be jumping off here periodically, and we'll go from there. All right? Thanks, everybody, and make it a great week.